at this board level talking about it quite a bit. And we deemed that we maybe could have the golf outing on July 27th, but everything we keep on hearing is that we'd have to enforce social distancing. So it'd be like one golfer per golf cart. We'd have to limit the number of teams to no more, or no players to no more than 72, or one foursome per hole. And there would be no networking. There probably wouldn't be a dinner. We couldn't congregate in groups more than 10. So for that purpose, we're deferring the golf outing until the fall. Hopefully the rules will change a little bit by then, and maybe we can have larger groups to assemble and maybe do some networking. So our current tentative new date is September 14th. So remember that. Hopefully we'll have some good announcements that's moving forward, and hope to see everyone there on the 14th. And then Susan, you want to talk about any other administrative stuff with the Teams platform?
Sure. So I'm Susan Ross Wells. I work with Bob at GJM, and just wanted to, once again, welcome everybody. We're excited to be using Teams for this meeting today, and just wanted to remind you, we're going to mute everyone as Bob starts his presentation, but no offense. But if you have any comments or questions, please utilize the chat, and Bob's going to attend to those, once he's finished with his presentation. So, and if you're not familiar with the chat, you can, if you hold your cursor, over the Teams screen, you should see that little sort of conversation icon there. So that little bubble, and if you click on that, you'll be able to make any comments or pose a question. So, Bob, I'll send it back over to you.
Okay, so I'm getting new at this, so now I'm going to share the PowerPoint with you.
Bob, you're muted.
Bob, you need to unmute yourself, my friend. So go to the bar, hold your cursor above that bar that I was just talking about, go to the microphone and click on it to unmute yourself.
Yep. Sorry about that, everyone. There we go. Sorry about that. All right. Now, are you seeing the PowerPoint?
Yes, sir.
Okay. Good. Yeah. So when I flipped over share screen, something to learn from Teams, the main screen that I was looking at earlier disappeared. It minimized itself. So I couldn't find the mute there for a second, but I got it now. Okay, so there's my resume. I think everyone knows me. 35 years of public accounting, work with construction clients. And so let's start right into the presentation. So on March 27th, President Trump signed the law, the CARES Act, and it added $2 trillion as a shot in the arm to the American economy. And it was really trying to really create liquidity in our economy. So, I mean, Congress knew that we were heading into a major recession. And in 2008, when we had our last major recession, they passed what they called the TARPS Act. And under that law, they put trillions of dollars into the banking industry. But that money didn't get into the banks until, well, 6 months to a year into the recession. And by that point, a lot of the banks refused the money and said we didn't need it any longer. So instead of using the banking system directly to provide the liquidity, they came up with this new program called the Paycheck Protection Program. And so we're going to talk a lot about that today, but that was designed to use small businesses through their banks to provide liquidity to our economy and basically keep people employed so they weren't getting laid off and going to the unemployment office. and then giving you some additional resources for small businesses to continue paying your rent on your building and your equipment, any mortgages you have on equipment or buildings, and then utilities. And because utilities are being really adversely affected right now. So they were doing that. So the first round shot in $348 billion into this program. And the first application was accepted on April 3rd. And then by April 16th, the money was fully allocated. And so on April 24th, Congress passed round two, which is the coronavirus relief bill. And under this act, they added another additional $310 billion into the PPP program. And also in the first round, there is, we're going to be talking about these economic injury disaster loans. And so also by April 16th, under the first round, all the money was used up for that program also. The well went dry with that program. So then under this second act, they injected another $50 billion into these economic injury disaster loans and supplemented that with another $10 billion in economic injury disaster loan grants. And we'll be talking about that shortly. So the big piece of the CARES Act that we're here to talk about today is the Paycheck Protection Program. It's basically was designed to go through the SBA's, the federal agency, and use the existing SBA 7A lenders across the country. So most of your banks were already in the SBA program, and there's a lot of other financial institutions that were already pre-qualified to underwrite SBA loans. So they decided to use that process. Many financial institutions accept these loans and started processing them. And there was horror stories initially when the program was first started. A lot of the smaller banks were actually taking manual applications and then going to their website within the bank and submitting them electronically. And so actually theirs were getting done sooner. And a lot of the larger banks were then setting up portals to have their customers go directly into the SBA through a portal at their website, like let's say KeyBank, Fifth Third. A lot of the big banks in town were doing this. And so that would eliminate the need for their people to process those loan applications. But it took time to build out those portals. And some of those portals were just finally being built out right before the money ran out. So there was, a lot of clients or customers that basically got shut out of the first round, had to wait for round two to get funding. So then when round two came around, there was $310 billion that opened up on April 27th. And just about everyone that has applied now has received their loans. And there, as of May 16th, there's still $145 billion available to loan out. So I got this off the SBA website. This is an update on the program. This is issued every week with current numbers. And they've combined both of them into one spreadsheet here. So this is both PPP round 1 and 2. So as of last Friday, they approved $513 billion of loans. There's 4.3 million loans, and almost 5,500 different financial institutions were involved in making those loans. And then when you look at the size of the lenders, almost all of them were smaller institutions with less than 10 billion in assets. About 5,361 lenders there. And some more information about lenders. But then here is the information by state. And so as you can see, Ohio is towards the bottom of the middle row. And combined in both rounds, we are now the 7th with almost $18.4 billion of loans being issued to customers in Ohio. And then this is the loan size. As you can see, a majority of the loans are under the 2 million, which we'll be talking about shortly. You understand the importance of under 2 million. But about less than 1% of the loans were under 2 million in number. And that made up about 21.7% of the total dollar amounts. So nearly 80% of the loans in dollar amounts are under the 2 million threshold. The average loan size now combined is 118,000. So as you can see, there's a lot of smaller loans. And again, this was going to all businesses with less than 500 employees. So there's a lot of small businesses that participate in the program. And then here's a listing of the lenders, the top 15 lenders, just to give you an idea. As you can see, there's the top 5 are over 10 billion, and then they start dropping off quickly after that. So let's talk about the basics of the Paycheck Protection Program. So the application allowed you to claim a loan of 2.5 months of your payroll cost to a maximum of $10 million loans. In final guidance, the loans have a 2-year maturity and a 1% rate of interest. You're allowed to use those loans for payroll costs, and that includes not just wages, but group health insurance, and retirement costs, interest on mortgage and payments, rents, utilities, and interest on other debt obligations, all incurred before the cover period. The cover period began on February 15th, 2020. Again, there's been a lot of talk about that. Do I need to set up a separate bank account to hold these funds? The question to that answer is no, you are not required to segregate these funds in a separate bank account. Matter of fact, a lot of the larger banks did not want to go through the process of opening all new bank accounts for these loans. And so once the money was approved, they simply deposit it in your main primary checking account. As part of this program, Congress allows a process for borrowers to get a potential forgiveness based upon spending the money quickly within 8 weeks. So again, the logic behind this is that we're trying to create liquidity in the U.S. economy. And so how do we do that? By loaning the money to these small businesses throughout the country, and then have them turn around and spend that money as quickly as possible. And that's how they came up with the 8-week period. So again, to push that money back out of those companies, back into their employees' paychecks. By doing that, the employees are comfortable that they've retained their jobs. The employers are comfortable that they're retaining their workforce. Once you start paying people money again, the withholdings go to the state and local government entities. That stopped when they went to the unemployment office. Retirement benefits continue to be accrued. Various positive things come out of spending that money. Also, they wanted you to make sure that you retained your facility and equipment that you need to operate. So that's why they allow forgiveness for payment of rent on equipment and buildings and utilities, because again, they want you to kick back into business as quickly as possible when we start going back to business and the pandemic hopefully starts to pass. So they put a date here of June 30th. Again, there's been a lot of discussion about extending that. There's also been some discussion about extending an 8-week period, but no true reaction yet on that. The big thing that caused a lot of angst initially was the certification required. So the loan application was very streamlined. Basically required 2 numbers, your payroll and your number of FTEs, and that you answer a bunch of questions then. The most important one, first of all, is you're less than 500 employees. And then second of all, this current economic uncertainty question. So on the loans application, you had to make a good faith certification that there was uncertainty within your company due to the pandemic, creating a necessity of loan. And so the actual certification that was on the application you signed was current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And so initially what happened was when this program started rolling out, the largest companies, they have the largest accounting firms, the largest accounting staff, legal, and these are publicly traded companies, apply for these loans. And so there was a carve out for less than 500 employees per location. So, and that was carved out for restaurants and hospitalities. So a lot of the publicly traded restaurant chains and hotel chains grabbed this money, applied for it, and got approved. And they could get up to $10 million. Now, again, some of these companies had 40,000 employees, but they met the definition of under 500 per location. And so they got the maximum loan of 10 million. And then when this became public information, because they're public companies, they had to notify, the public that they did this. There was a big pushback from the public. And so the SBA is providing guidance to what they call the Q&A. And so when they got this pushback, they did a question and answers, number 31, that speaks to, okay, who really qualifies for this? How do you perfect this certification? And so they said, you really got to consider your ability to access other sources of liquidity. And it went on to say definitely in that Q&A, it is unlikely that a public company with substantial market value and access to capital markets will be able to meet this required certification. So this was definitely targeting publicly traded companies, but it also was targeting other large institutions, so like the LA Lakers, which I think are probably fully funded. It's $1 billion company. Probably has other access to liquidity to support their operations. So again, they were another one. And so they said, hey, if you pay it back initially by May 7th, no questions, no foul, and then extended that to May 14th. And right around May 14th, they made another ruling. That was Q&A number 47. Okay, and that ruling was basically if you had less than $2 million of a loan, that's why that 2 million became, that I spoke about earlier, is important. If your loans were under 2 million, you automatically meet this certification. You don't need to demonstrate to the SBA. If you're over 2 million, the SBA could come in and perform a review and ask you to demonstrate how you met this certification. And also they can do a deeper dive into your forgiveness request. And because they issued it, I think on May 15th, they then extended to May 18th, the day you could repay your loans, no question asked, if you're over that 2 million. So what happens if you don't meet this requirement and the SBA deems that you did not meet the requirement of the certification? Their remedy is that you must pay back the loan and get no forgiveness. And that is it. They've declared that there will be no criminal enforcement as long as you made a good faith effort in your certification. Other questions we've seen is like, I have a line of credit. Does that create some problems under certification? Again, it was very clear in the CARES Act that they said that you did not have to consider your other sources of financing in being eligible for the Paycheck Protection Program. So they clearly carved that out, even though other SBA programs require that. And so a lot of clients, when you really think of a line of credit, and there's so much uncertainty going on in our economy right now. And I don't know a single client that has not been, a company I know of that's not been affected by it. And we were hearing some horror stories. I was on a client call yesterday where their sales are down 95%. Now they're in the auto industry, a supplier to the auto industry, but still 95%. And we've heard other clients down 75%. And two things, when you have a line of credit, lines of credits are usually not available to fund losing operations or payroll. Lines of credit are there to support growing businesses and provide liquidity based upon the receivables and good inventory. And usually, most of our clients have seen a decline in sales temporarily and their corresponding receivables. So while they might have a line of credit, they might not be able to access it. So because they don't have the collateral base. And likewise with inventory. I mean, a lot of contractors don't carry inventory, so this doesn't impact them that much. But again, inventory. So we're recommending everyone document their uncertainty when they sign your application. Everyone, even if you're under 2 million, you should just make a quick memo to the file. That's the uncertainty. Everyone I've talked to is facing some uncertainty. And some of the documentation you can support that is, I know a lot of customers or companies have done forecasts that shows what happens when their sales drop and what happens to their profitability and what happens to their cash depletion. You might be sitting on some cash right now, but that cash maybe will get quickly depleted if the receivables aren't coming in. Reduction or slowdown in collection of account receivables. We're hearing a lot from construction companies while they're burning off their backlog. The bid opportunities are really slowing down temporarily. And we're hearing from other customers, contractors, that they have current projects where maybe the banks now is slowing down the ability to draw on construction loans to fund those projects. So again, that's slowing down. Supply chain, we're hearing from a lot of contractors. I'm having all kinds of issues with getting some contractors on there at the right time, because certain subcontractors aren't bouncing back as quickly as other ones. And so timing all that and getting them there so you can get the project moving forward. Maybe obsolescence or perishable inventory losses. And the big one I keep on hearing too about construction is work stoppage or cancellation. So again, we have a lot of customers that, let's say you're a factory and all of a sudden someone comes down with COVID-19 and you must shut down that factory. And therefore no one's allowed into it. And that could be shut down for a couple of weeks. Or local governments. I know the city of Toledo shut down a lot of their construction jobs for a month and said you cannot no longer come out to the construction site for at least a month. So again, there's so much uncertainty. Just document that. So the forgiveness period. So that's the most important thing that's now people are starting to talk about. So so it begins in the 8-week period after the loan originated. So let's say your loan was funded on April 20th, then basically on April 20th, the 8-week period starts. And you're allowed to get forgiveness in 2 categories of costs, which we'll go through each one. One being payroll costs, another one being non-payroll costs. Okay. On May 15th, last Friday, SBA issued their forgiveness application with supporting instructions and also with some supporting schedules. Now, a couple questions I've been getting recently on that application. There's a link to their website right there in the PowerPoint. But some of the questions I've been getting on this application there's this worksheet that's attached that helps you figure out some of the answers. That is not part of the formal application you submit. You do not have to use that worksheet. That's just a guide to help you guide you through it. Some people find that worksheet to be a little cumbersome. So you do not have to use that attachment. You just have to fill out the application. So one item that's been constantly been debated, and it was in the CARES Act and is repeated in the instructions for the forgiveness application, is a concept called paid and incurred. Basically, they want to make sure not only were these expenses incurred prior to or during your 8-week forgiveness period, but that they were also paid, either during the 8-week period or paid shortly thereafter. So we're having a lot of questions about, okay, I have a normal 401k that I do at the end of the year. Can I accrue part of it now? Well, first of all, you got to look at your 401k plan document to see if you're allowed to do a partial payment, but it's going to have to be paid in during the 8-week period. You can't wait until after the forgiveness period to pay it in. Also, it's pretty clear from this application that any prepayment of expenses will not be allowed. So, for example, you cannot pay by, let's say, June 15th, your July health insurance bill. But you do get to pick up the prior 2 months worth of health insurance. So you shouldn't be harmed. Just make sure you're picking up the right ones. So what are payroll costs? So payroll costs is the same definition and the same calculation you use to draw down your original PPP loan application. It has not changed. So it starts with salary and wages, not to exceed 100,000 per employee. And if you're a single member LLC or you have an LLC and you're getting draws instead, it's also limited to 100,000 per member. So for the 8-week period, the maximum any person can be claimed for wages is $15,385. That's the maximum. Then on top of that, you get to add group health insurance, and this includes union health and welfare benefit payments, or if you're self-insured, those payments. You get to include retirement benefit costs, and again, including the union retirement benefit cost. And then there's a small carve out for state and local taxes based upon employees' compensation. So in Ohio, we have 2 of these, state unemployment and workers' comp. So with state unemployment, it's relatively small for most of the companies we know. And again, it might have already been paid. I don't know if there's going to be much that you can pay during this period, this 8-week period, but if you can, that should qualify. And likewise with workers' comp has deferred payments for the next 3 months, and they're going to give everyone a rebate, and you will never have to pay those payments from the rebate. So again, I don't know if there's going to be a lot of workers' comp you can claim. There is something in the application that's new. It's new guidance to help you maybe pick the 8 weeks of payroll and these related costs to use. And they have what they call the alternate payroll covered period. So if you choose that, which I'll be going over shortly, you would have to follow that same procedure for all the costs on this page. So what is the alternate payroll covered period? It's designed to align with the borrower's payroll schedule. So you get to, if you would like to use the first payroll for the first day of the company's first pay period after the PPP loan disbursement date. So it doesn't have to be exactly the day you got the loan. It could be their first payroll after that. So in the example, in the application, they give an example. The loan was funded on April 20th. However, their first payroll doesn't begin to the 26th. So this company can choose to start their 8-week period on April 26th, which would change the ending date to June 20th. Now, again, if they had not done this, the period would have ended a week earlier. So April 20th, I think it would have ended on June 13th instead of the 20th. So again, so this makes it easy. Again, it's pretty clear that there's going to be 8 weeks of payroll. The other question we keep on hearing is, can I increase someone's payroll during this period? And there is no prohibition about increasing payroll. There is a subtraction, and we're going to talk about later on about reduction in payroll, but there's no prohibition against increasing payroll. And again, there's a lot of companies that we talk to in all industries talking about paying hazard pay, which is actually strongly recommended from the standpoint that, during this period, your employees maybe are exposed to higher risk. And so you can pay them hazard pay, but you can also pay them a bonus. It's just the maximum that can count for any one employee is that $15,385. So here's an example on how you calculate the payroll component of the forgiveness. So there's the payroll cost for the employees at $15,385 per employee of $435,000. Then their health insurance for 2 months of $50,000. Retirement benefit costs, these are matching, $25,000, and a small amount of state and local taxes of $15,000. So in this example, there's $525,000 allowed. Now, what's also important about this number is that's going to limit the non-payroll. And so the maximum non-payroll costs cannot exceed more than 25% of the total forgiveness. So this number drives the maximum amount of non-payroll cost. So again, the non-payroll cost cannot exceed 25% of the total amount forgiven. So when you do the calculation, it's going to be the lesser amount of your actual costs in these 3 areas, or 25% of the total amount available to be forgiven. And so the non-payroll costs fall into three buckets, one being rent, one being utilities, and one that they've titled mortgage interest. And so what is rent? Rent means any payment for a rent or lease that was obligated under an agreement that existed prior to February 15, 2020. It's pretty clear from this application that it is rent or lease on real estate or personal property. So this would also include truck leases, scissor lifts, anything you're leasing. I had one company I was talking to where they're leasing your uniforms under a rental agreement. That should qualify. So anything should qualify, for as long as it's personal property or real estate and it's under a rental arrangement. Also, the construction industry, there is times when you might rent equipment for a job site. And if that rental agreement was executed prior to February 15th, and you paid costs under that agreement during this 8-week period, that should also qualify for forgiveness. The next category is utilities. And so, this industry is getting slammed by the pandemic. The draw on electrical utilities is drastically down. I mean, all these big factories that shut down are paying no utility bills. The gas is getting slammed. Water is being used a lot less. And so all these industries are really struggling. And so they've added this in that if, again, you got to document that you've already had been paying these bills prior to February 15th. So it can't be for a new location or something like that. It has to be existing utilities that you have been paying prior to February 15th. But your electricity bills for 2 months, your gas bill for 2 months, your water bill for 2 months, your telephone bill. And this would also include cell phones. A lot of organizations don't have landlines anymore. They rely upon strictly on cell phones. So that would qualify. Internet access will qualify. And the last gray area out there in this list is transportation. And that was put in by Congress directly. And again, without a lot of guidance. And so the only guidance we've seen so far is the SBA has provided some guidance to small borrowers. These are Schedule C borrowers under the PPP program. And they talk about use of utilities. And in there they say, transportation cost. And they say, for example, fuel you use in your vehicles would qualify. So it's pretty apparent from that SBA for small businesses that it qualifies, fuel counts. So again, I think you can take that position for all. I mean, there's already a position taken for small organizations. And again, I mean, we used to know gas prices, it's been dropping drastically. I can't believe the other day I bought a tank of gas, 17 gallons for less than $4. I paid 19 cents a gallon. It was $1.19 at Kroger's and I had $1 off because that's all we're doing is shopping at Kroger's now. And so it was unbelievable. And that industry is really getting damaged. And the last area is interest or mortgage obligations of the borrower. So again, these have to be a liability of the same borrower of the PPP loan. And again, it's defined as where you have a mortgage on real estate or personal property. And again, in the application, it says both of these. So this is not just loans on real estate, but this is loans on equipment would qualify, the interest on that. The only thing is that loan had to exist prior to February 15th. So any new loans after that will not qualify for this portion of the forgiveness. So here's an example. In this company, they have $85,000 in qualifying rent, $101,000 in qualifying utilities, and $6,000 in interest. So their total available for forgiveness is $192,000. However, because they're payroll, the maximum they can get is $175,000. So they would only get $175,000 of the $192,000 forgiven. So after you come up with the costs eligible for forgiveness, the next step is that you have to complete 2 tests to see if any of that forgiveness will be reduced. And so that forgiveness, the cost forgiven can be reduced if 2 things happen. Your FTEs don't meet a certain definition, full-time equivalents, or if you reduce people's salary by more than 25%. I don't know of anyone that I know of a company that has been able to retain employees and get them to come back to work at a lower salary. Unfortunately, the unemployment benefits out there are far better than the salary you might be currently offering, let alone with a 25% reduction. So again, I don't see this impacting a lot of clients, but it still has to be remembered that that's a potential if your compensation is less than 25% of what they're getting prior to the pandemic. And again, we'll go through examples of each one of these. So the FTEs, there are 2 look-back dates. You get to choose the lower of the 2. So you first calculate your monthly average FTEs from February 15th to June 30th of 2019. This is a year before the pandemic. Or your average between January 1 and February 29th of 2020. This is right before the pandemic started. And you get to use the smaller of the 2. FTEs will be calculated based upon the 40 hours. So this is something that we thought could have been 30 hours, but in this final guidance, it's 40 hours. And the reason we had originally thought it was 30 hours is that in other portions of the CARES Act, they do reference 30 hours. However, for this, SBA has ruled that you're going to do this based upon a 40-hour FTE calculation. Again, if you're using an alternate payroll cover period, you must use that period to calculate your FTEs and not the 8 weeks after you got the loan. The thing is that no person can be greater than 1 FTE. So if you have people that calculate out more than 1, you cap them at 1. And then for those that are less than 1 FTE, you have 2 choices. You can either round them to the nearest 0.1, or you can elect to consider everyone under 1 at just a half of an FT. So again, what we're recommending is you calculate it both ways and see which works out to your benefit. So here's an example. So in this one, the company's FTEs during the 8 weeks was 32. A year ago, they were at 41. Right before the pandemic, they were at 38. So we take the lesser of those 2 is 38. So they went down 6 FTEs. So their loans can be, their forgiveness amounts can be reduced by 15.8%. Now there are 2 safe harbors for this. And the one is where you get to consider your reductions. If your reductions occurred between February 15th and April 26, 2020, this will be disregarded if you rehire equal FTEs by June 30th. So again, if you simply do this, that's a safe harbor. You do not have to do anything for FTE reductions. So again, we're encouraging everyone to look at this one hard. The second one is an exception. So let's say you call up your employees and say, come on back. And they say, no, I like my unemployment. It's better. And Congress and the president are trying to fix that right now, but unfortunately they can do that. So if you make a written offer to rehire them, and it was rejected by the employee, or any employees who were during the cover period were fired for cause, they resigned, or voluntarily requested and received a reduction of hours, you do not have to count them as a reduction. You get to treat them as though they were still there. So again, that can improve your ability to meet this FTE test. The other one is the compensation reduction. So again, you have to look at what you're paying people either on a salary from January 21st, 2020 through March 31st, or based upon their hourly rate. And if you reduce your salary or their hourly rate by more than 25%, there is also a reduction that could happen to your forgiveness. Again, as long as you correct this reduction in salary by June 30th, this is deemed not, you don't have to go through this calculation. So let's say you gave someone a salary reduction and by June 30th, you brought them back to their regular salary, that you don't have to consider this. So it's allowed to be cured. So here's the calculation altogether. So in this company, they got a loan of $700,000. As we've already went through, they had payroll costs of $525 and non-payroll $175. So they're entitled to get the full loan forgiven. However, they had a 6 FTE reduction. So $110,000 of the forgiveness was disallowed. Plus they had a little compensation reduction of $6,250. So the maximum forgiveness they're going to get is $583, leaving $116,000 as a loan to be repaid over 2 years at 1%. Other items to know is that there's these SBA economic development disaster loans, which we're going to be talking about shortly. Again, if you got those during those periods, you're not eligible for forgiveness. Additional guidance will continue to come out. And again, SBA has the final say on forgiveness for all loans. IRS position. IRS recently ruled on April 30th. So in the CARES Act, Congress said we wanted to give two benefits. We wanted to give forgiveness, and we didn't want to make this forgiveness taxable. The IRS ruled on April 30th that they agree with Congress that the income is not taxable. However, expenses paid by using these funds are not tax deductible. So they basically took the tax deduction away. There's been a lot of pushback by this. Everyone's pushing back hard on this. Congress has already said that if the IRS doesn't reverse this, they might correct this in a future law and make it tax deductible. There is this employee retention credit. Gives you, again, you have to demonstrate for this one that you've been economically harmed. And that is defined by a reduction of your revenue by more than 50%. It gives you up to $10,000 of credits against your FICA tax. It's a refundable credit. There are one set of rules for under 100 employees. Everyone qualifies. Over 100 employees, they had to, you have to tie in whether or not they left because of the pandemic. Again, a lot of clients aren't using this program because they're using the PPP program. Who qualifies? Anyone that was partially or fully suspended due to the order, government order due to the pandemic. It experienced more than a 50% reduction in gross receipts. It's available to exempt organizations. It's not available to certain government employees. And if you're getting a PPP loan, you can only use these credits up to the end of your forgiveness period. So you only get about 8 weeks of using this credit. And you can't go beyond that forgiveness period. Again, here's how you calculate the reduction. You compare your gross receipts to the first quarter, either last year, as you first quarter this year, it's more than 50%. You get this credit, and it continues until your gross receipts exceed 80% as compared to last year at the same time. And mechanically, the first time you can claim these credits is on your second quarter 941. The credit came into existence on March 13th. So there are about March 13th through March 31st in the first quarter, which you claim on your second quarter 941. It's a refundable credit, and you use IRS Form 7200 to claim this credit. A lot of businesses that are claiming this credit are currently using their payroll service provider to provide this credit. Also, as part of this credit, there's a payroll tax delay. So if you qualify for the credit, you also get to delay paying any additional FICA tax you have for the rest of the year. So you have to pay no FICA payments this year, and those are repaid over the next 2 years, half in 2021 and half in 2022. Again, if you're using the PPP program, you can only use this delay up to the end of the forgiveness period, which is your 8-week period. So there's one other program we want to talk about, because you can use this also if you're getting a PPP program loan. It's the Economic Injury Disaster Loan, and this has been around for years. Again, this is normally when there's a natural disaster. The last time this was used significantly was in New Orleans when the hurricane destroyed a ton of businesses. And so they went down there and they provided a lot of businesses economic disaster loans. All 50 states have been declared economic disaster area due to the COVID-19 pandemic. If you qualify for this, you also get a $10,000 grant. However, this grant will reduce the amount of loan forgiveness if you're also using the PPP program. So you lose $10,000 of your forgiveness under the PPP. You can apply for both. However, the danger here is that they both could fund the same cost. So let's say you got this economic injury disaster loan at the same time you got the PPP loan, and most of your cost is labor and these other costs that you're asking for forgiveness. They're going to take the position, SBA could take the position that the economic injury disaster loan paid those costs first, not the PPP loan, which could minimize the amount of forgiveness you get under the PPP program. So we're recommending for most companies that, if you're doing a PPP, get to your 8 weeks and then apply for this economic disaster loan. There's, like I said earlier, there's a significant amount of money put back into this program under the second act. Okay, so again, it's designed for small businesses. You must demonstrate that you've been economically harmed due to the pandemic. This is a loan. You must apply with the SBA for this loan. You go through normal SBA loan underwritings. It follows all the normal SBA rules. There's no exception for less than 500 employees. You must meet the normal SBA guidance for a small employer. So it's just a basic same SBA loan. If you do qualify, what's nice about it is the repayment term is 30 years. And the interest rate will not exceed 4%. And that's how you apply for it. There's a link to the. So here's the decision tree that we've been walking through with most of our customers. First decide if you're doing a Paycheck Protection Program or economic injury disaster loan. And again, so, under the Paycheck Protection, you get up to $10 million, 2 years to repay for amounts not forgiven at 1%, and you apply through your bank. Okay. And then you can also later on do the economic injury disaster loan. After that, apply for another $2 million, get up to 30 years terms. We've had a few companies get approved for this. The interest rate they're being quoted is 3.75, and you apply directly with the SBA. Now, if you're doing the employee retention credit, you can do that easily with the economic injury disaster loan, but it does not work well with the Paycheck Protection Program. You only get that for the 8 weeks. And then the final slide I have here is just on other state programs. I want to leave a few minutes here for Q&A. So again, there is the Bureau of Workers' Comp. They're deferring their payments for March, April, May. And they've also announced, and I think everyone's been notified of a $1.6 billion dividend back to the employers. And again, this is 100% of all premiums they collected in 2018. And they're going to use this part of this refund to fund that March, April, and May deferment. There is another program that a lot of people maybe not are familiar with called Shared Work Ohio. It's a voluntary layoff aversion program through the State of Ohio Unemployment Office. Again, this works to allow you to retain your employees during a time where you have reduced business activity. So what you do is you negotiate with the State Unemployment Office that you're going to reduce everyone's hours. Let's say you could do up to 50%. Let's say you reduce everyone's hours by 40%. And then the Unemployment Office will make up that 40% with unemployment benefits. And these are not counted against you as unemployment benefits paid. So it's a neat program. There's the link to their website. So the key word, if you're looking for CPE, is COVID, COVID. That would be the key word. So do we have any questions?
Bob, we did have some good questions come in the chat. Do you want me to just start reading off a couple to you?
Yeah, sure.
Okay, this is Susan. All right, I'll start with Mercedes. She says page 9 of 11 from the SBA PPP loan forgiveness application defines how to split employees between tables 1 and 2. And table 1 says that one should include, quote, employees that were not employed at any point in 2019. She wants to know, what if these new employees in 2020 earn more than $100,000? Would you add them to table 2 or to table 1?
I'd have to look at that, but I believe you still put them based upon when they were employed. So I think I'm trying to get the application in front of me real quick, but I think you would still put them. I thought, let me see if I can I'll have to get back to Mercedes on that one,
Yep,
but I believe
okay.
you put it in the right section.
Alrighty. Okay, Andrea had this question. She said, in regard to the paid and incurred portion, the majority of utilities aren't going to line up with the 2-month period covered. Should they just take the closest bills to that covered period? And secondly, can you count reimbursement for employee-owned cell phones on the telephone portion of that?
Okay, so let's answer the first question. So the first question is, yes, you just get 2 months. You don't have to align with the 8 weeks. So it's not like a more of an accounting concept where we're trying to get just 8 weeks exactly in there. So as long as it lines up, as long as you get 2 months, you get 2 months of utility bills. Okay. And so I think you could, if your utilities are going slightly up, you might want to select the later 2 utility bills that gives you a higher amount of forgiveness. The employee reimbursement for employee cell phones, I think that could be an issue because it doesn't meet the definition of an agreement necessarily that was in place prior to February 15th. Because you don't know when the employees entered into their cell phone service. And again, it's not in the name of the company.
Okay.
It's in the name of the employee. So I think that one could be more troublesome.
All right. Okay, Terry had this question. Does garbage qualify as a utility?
I don't see that on the list. I don't know. That's a tough one. I don't see it on the list. I don't see it being gas, transportation, telephone, internet. Those are specifically defined in the law, the ones listed there, and nothing else. So I think that'd be a push.
All right. All right, here's another question from Mercedes. Their 8-week period of the PPP loan ends June 7th. Do they need to wait until June 30th to submit the loan forgiveness application to the bank, or can they submit it June 8th, 2020? They have read that the banks have 60 days to get back to borrowers with the forgiveness decision. Would you agree with that?
Yeah, I agree with that. That's true. Now, the only reason you might want to wait is if you're trying to use one of those safe harbors to eliminate any reduction created by an FTE or salary, because you have to June 30th to cure that. So if you submit by June 8th, you've already said that you're not going to have a deduct for the FTEs or the salary reduction.
Okay. All right, Beth Ballet wanted to know, can monthly payments on company vehicles be included in non-payroll costs under transportation?
So if it's a rental, yes. If the company's entered into the rental arrangement, yes, that would qualify. If there's a loan, then the interest on that loan, as long as it's in the company's name.
Okay. All right, Tim wants to know, do attribution rules apply for listing owners' salaries and wages? And then he notes Schedule A, line 9.
Schedule A, line 9. Now there is attribution rule. So that's a tax concept. And so I don't know how that layers into an SBA forgiveness. Because again, we're following SBA guidance here, not IRS guidance. So I don't know the exact answer to that. And what line was he referring to? I found the application here.
Schedule A, line 9, he said.
Schedule A, line 9. Let me get there. Yeah, I do not know exactly how that would impact there.
Okay, and here's a quick comment that Gabriella had saying maybe it would be better to pay a bonus to the employee than it would to cover the phone costs, rather than doing that reimbursement. Maybe that's another way to handle that.
Yeah, it could be. Yep, they very well could do it. It's a good idea.
Bob, that's all I'm seeing in the chat area. I don't know if anybody else has any other questions and they want to unmute themselves at this point. Feel free. Bob, you've left them speechless.
Exactly 10 an hour too.
Excellent presentation. Thank you so much.
You're welcome. And I'll follow up. Let me look into your question, Mercedes. I'll get back to you.
No worries. Okay, bye-bye.
Bye-bye.
Thank you. Bye.
Yep. Is that it? Then I guess we're good to go, everyone. Thank you for joining in. I think, we had, I don't know, about 30, 35 people on this. So thank you everyone for joining in.
Thanks, Bob.
You're welcome. Take care, everyone. Stay healthy. If anyone has any questions, just reach out.